Welcome, I'm Catherine Magana here with Steve Wolf, Greg Carroll, and Vince Stefano, where we're here to provide you insights on the markets and financial planning. And here we are, today is March 6th, and since last week, it's been a seesaw market. There's been a lot of movement.
Which part is up, see or saw, or which part is down? Because it's been one or the other.
Hold on. I might feel a little seasick, but from all this. But just looking as of yesterday's close, which was yesterday would have been March 5th, the Dow Jones was actually up year to date a little bit. And pretty much all the other indexes, NASDAQ, S&P, and the Russell 2000 were all down. But as of today, and we'll see where we end up today, the markets are down and wiping out any of those gains, at least in the Dow Jones, and continuing to go down in some of these other sectors. Yesterday was interesting because the markets, it seemed like it was a positive tone with the auto tariffs and kind of Trump holding off on some of those another month. But I feel like the market's still not trying to figure out what's going on with the tariffs, and there's been a lot of movement recently. So it's one of these times where we do have these conversations a lot. The markets don't always go up; they do fluctuate. There are times it goes down in value. There are corrections, and it's obviously making sure that you have a solid plan and investment allocation along the way.
I think the average drawdown in a typical year in the S&P 500 is like 13 or 15%, and we're down 5 or 6.
So when you say the average drawdown, you mean that's how far down it'll go within a particular year?
In any given year, the average has been 13%. Okay. And it doesn't mean it's negative for the year. Right. It just has a drawdown.
Are you talking from the highs or?
From the highs.
From the highs, okay.
Yep.
Yeah,
Yep.
that makes sense, yeah.
So every year pretty much almost sees some major downturn. Well, major meaning 10%, 15%, something like that.
Exactly.
Okay.
Exactly. So we're not in anything unusual, and obviously there's a lot of transition going on out there, to say the least, with the new administration. So,
well, and again, when you look at drawdowns, I don't know if any of the broad indices have hit bear market territory yet. I think intraday, some may have. As Catherine just said, yesterday was one of those days where it declined substantially in the morning, then rallied hard in the afternoon. I don't know if it hit bear market territory or not, but right now, you got the markets worried about, a weakening economy. Overall growth concerns are kind of hitting the market big time, as well as tariffs. And, is it going to be higher prices? Is it going to drive down consumer sentiment and consumer spending? Which it very may well if they turn into a major trade war, which I don't know if that's going to happen. There are some talking heads who are saying that we're very close to a washout and that you may see higher market prices in the next 2 or 3 weeks. But close is only counts in horseshoes and grenades. So right now, the market
it counts in Scrabble, too.
Well, okay, I like horseshoes and grenades. But, I mean, the market seems to be bouncing off its 200-day moving average. And for those that don't know, it's just the average price over the last 200 days. Today was the first time I saw the S&P actually crack its 200-day moving average, drop below. Now, the big question is, are we going to see buyers come in? I don't know. When you were talking about the drawdown, most of those drawdowns had witnessed a subsequent V bottom. I don't know if we're going to see a V bottom this time. I think we may see a W bottom. And I'm serious. No, I mean, there's a W bottom. I mean, you're going to come in. Yeah, it's alphabet soup. We got a rebound. We're going to get a sell-off. We're going to test the lows again. And once they test the lows, that's when I think a lot of investors may come in. I did see Fox Business News had a poll, and bullish sentiment was at 19.4%. I don't know how that is in your little grid.
So what does that mean at 19%?
It means it's damn low.
Exactly.
And bearish sentiment was at 60.6%. So,
right. Well, the CNN Fear and Greed Index was at 18.
Okay.
So 0 to 25 is extreme fear. Yeah, so that's where it is right now.
So we're we're in extreme fear, but the crazy thing is, if you look at yields, you look at oil prices, they're all coming down, and that should be very good for the market. But it's right now not good for the market. So we're in kind of a funky period. I think that a couple of weeks ago we talked about scrubbing your portfolios, taking out stocks that were not, the most seasoned stocks, and keeping some cash positions. If you've done that, you're probably in a very good position. And the only thing I can say right now is, we're going to get through March, get into first quarter earnings. But until then, until you see some decreased volatility in this market, I would say keep your hands and feet inside the ride.
What exactly does that mean?
It means don't try to time an up or a
it's
downside.
hard.
Don't make
Yeah.
stupid
I mean,
purchases.
every day the markets are moving. You can
and
miss
don't
the market.
don't think, I'm missing something because it's going up, because like today it's just completely reversed yesterday's gains, and we're actually down more than we were up yesterday. So, if you've got cash in your portfolio, it's a good thing. Keep it until you see less volatility, and then find stocks that you really like, you feel confident in, and then, you can probably buy at some lower prices.
Well, as usual, it's tech stocks that are leading the way. They led it up, they're leading it down. And you have to remember that the S&P 500 is filled with tech stocks. The top stocks are a major percentage. The top 7 stocks are a major percentage of the S&P. They're even a bigger percentage of the NASDAQ, which is why the NASDAQ, which is the more technology stocks, moves greater, both up and down. Did a little research here, and just out of curiosity, I wanted to see how often do we have a decline of 15% or more in the S&P 500. And basically it says since 1928, the S&P has dropped 15% or more about once every 3 years on average. Since 1980, there have been 10 declines of 15% or more. So, I mean, this is not unusual that happens.
So is that different than what I was referring to earlier as far as the drawdown? Is that like a negative year, or?
This is more of a negative year.
Oh, okay.
Yeah,
So
this
the whole
isn't
year
a
it's
drawdown.
down. Okay.
Right, the
so-
whole year is down.
Gotcha.
Okay, and if you look at the NASDAQ, 15% declines happen about once every 1 to 2 years. Okay, that's for the year. All right, now if you look at 20% declines, it's a little bit less, but it's still a lot. I mean, since 1971, when the NASDAQ was created, there have been about 12 to 14 bear markets. And by the way, I'm getting this information from ChatGPT. Okay, so if it's not exactly accurate, don't blame me, James. Blame ChatGPT. But I'm pretty sure it is. In 2022, we were down 35% over 13 months. In 2000 and 2002, the NASDAQ, and this is what I'm talking about, was down 78%. And that was over a 30-month period of time. Okay.
That was brutal.
That was brutal. And some people are saying that this is like that. And I don't agree. Okay. And the reason I don't is because so many of those .com stocks had zero business. There's no profits and everything else. The stocks that are getting hit the hardest are the big stocks that actually are making a lot of money. So for them to be down anywhere close to that would be, I don't know what would have to happen. I don't care about trade wars and tariffs and whatever. I mean, something else would have to happen.
Right.
It means we'd have to also stop using all the new technology that we're using today. And in my opinion, I think that that's the opposite of what's going to happen. So remember, Warren Buffett had the best quote on this, that in the short run, stocks are a voting machine. So people are voting on, okay, I like this, I like that. But in the long run, it's a weighing machine. How good are these companies? And I think in the longer run, and we're gonna have this wash out a little bit, as Vince was talking about. I still think a lot of these companies are really good companies, and the difference between buying an individual stock, of course, and buying the index is there's so many people right now that buy just an index that when they start selling, everything goes down. Okay, of course, when they buy, everything goes up. But it goes down faster than it goes up. Always, fear is a bigger emotion than greed is. It just is. So I would be careful about making, as you said, making any rash decisions during this time frame. I do think we're still in for some more, downward movement, simply because there's a lot of unknowns out there. You talked about the tariffs. We don't know where that's leading. And that, of course, is a problem. And I heard this morning that Trudeau from Canada was saying that we're going to have a trade war with the U.S. Okay, we'll see if that happens. Mexico, on the other hand, seems to be going the other way. So we don't know where it's going, and that's the reason why I think the market is having its downward move. But if you look at individual stocks within that, they're still doing great. I saw one company come out this morning with fantastic earnings, but they said that next year might not be quite as good, and it's down 16%.
Right.
Okay, so guys, be careful right now.
Yeah, it's funny that Warren Buffett also, buys when other people are selling, right? And one of the terms that I started hearing a lot in the news was American exceptionalism, referring to our stocks, our stock market, and avoid Europe, avoid China, especially China. China's been horrible. What's happened this year? We're down, and those markets are actually doing very well. So being a contrarian sometimes and not just following the herd can really make a difference.
Well, I think that's where the fear and greed index is a good indicator, because when everybody is scared, that usually means that everybody is selling their stocks or certainly isn't buying. Of course, that could stay there for a while. I mean, we don't know how long people are going to be afraid, and it can get worse. But generally speaking, when you have this type of marketplace, this is when you should be looking for buys. Not so much sells. If you're overweight something a lot, you probably should, if you haven't already done it, you probably should have done it. But maybe now isn't still a bad time. But I would be more looking for companies that I think are great that have gotten the heck beaten out of them because everything is just being sold right now. Right. Okay, so it's a good contrarian indicator. It's I think you're exactly right. When we have the only industry that I know of, I think I've said this before, is that when everything goes on sale, everybody walks out of the store.
Everybody walks out. Yep. That's right.
It's amazing.
Yeah, I agree with you. And I think, you had mentioned the tech stocks and the NASDAQ and all that. And if you look at the top 20, just say the top 20 stocks in the NASDAQ right now, they're getting a whole lot cheaper than they were 3 months ago. And if you're looking to buy some really good companies, that's kind of where you want to focus. Focus your attention on some of these stocks that, are really good, innovative companies that, they're going to be around for the next 25, 30 years. Amazon's is not going away. Neither are some of these other big companies that you see in the indices. So stay with the good names.
But we're not suggesting anybody in particular.
No,
okay, we get that. But there's a lot of names outside of that that are also getting hit because, again, when indices get hit, everything in the index gets hit. Right. Okay, so there may be, in the last year you've had stocks that are not tech stocks up by, in the last year and a half or so, up by over 100%. That's pretty good return.
Right.
How many years would you have to be in a CD for that? So I would look not only in tech, I'd look at any good company that is just getting hit because the whole market's getting hit, and it's not particular to that company. That's really a good way, I think, of buying companies.
With a lot of the indexing going on out there, passive index investing, you're right. When a market's going down and they're selling those big stocks, the indexes have to sell all the stocks, so that contributes a little bit to what you're talking about as far as everything kind of going down,
right?
And even though they've got good earnings and they're doing
or there might be some technical analysis or different things that trigger trades to be done when the markets go down.
Right. There's technical analysis is actually a really big one, especially with the algorithms of some of these.
I was going to say the algos now are taking over the entire trading market. I mean, you're just pressing buttons; they don't care.
Right. So you've got the algorithm that says if it's down by X amount, you're going to sell something. If it's down by X times 2 or something, we're going to sell more. But that's the opportunity for everyone else, okay? People say to me, how can the market go down so fast? Well, when everything is done by machine, it's not humans who are really saying, okay, I'm calling my advisor and saying sell. It's a machine that it controls many, 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 many different shares of stock, and they're doing it instantly.
Yeah.
So, again, it's harder to pick stocks. So I'm not suggesting that everybody should be a stock picker. Maybe you've got an advisor who's a good stock picker. That's fine. But just be careful about where you're going right now, be looking to see maybe there is going to be a washout if it's not already happened. There's a lot of individual stocks that are down by way more than what the market is down.
Yeah, a lot of these stocks are getting washed out big time, but
Right.
they can stay washed out for quite a while.
Well, that's it.
That's it.
But if your time frame is not the next 6 months, which it never should be if you're investing in almost anything, if your time frame is proper, which should be more like 3 to 4 to 5 years. I'd be willing to bet, and I do bet with what I invest in, that 4 or 5 years from now, a lot of these stocks that are getting hit hard today will be much higher than they are. So we'll see.
Yeah. And you probably if you're retired, you probably have a mix of different investments. You have Social Security or pensions, and so it's
Is Social Security an investment?
No, I say you may have other. You may have pensions
Sources
or
of income.
sources of income coming in. I'll correct myself there.
Because I'm not sure I would invest.
Yes.
I would invest in Social Security.
So you may have other sources of income coming in, not just from your investments, or you may have some bonds or some money set aside to cover your expenses. So once again, we're focusing a little bit more on the stock portion, but the reality is overall you may have an allocation, a mix of stocks, bonds, and money market.
And that's a really good example of why you should have diversification, especially as you get older. All right. If you're 60, 70, 80 years old and you're 100% in tech stocks, that's probably not where you want to be. You want to have some sources of income where you're getting income and not just hoping that a stock is going to go up, if that is what you're living on. So I think diversification works. You could probably make more over a long period of time. You will make more over a long period of time. Based on past history. Of course, we have to say that past history doesn't mean it's going to happen in the future. But when it's happened for 150 years, I'm pretty sure that's going to happen. So, if you have a stock portfolio and it's purely stocks, over the next 5, 10, 15, 20 years, you'll probably do well. But the next 2 or 3, you could get wiped out if you're living on that. So you got to be careful with what that allocation is. So I agree with you 100%. Yep.
So another topic on retirement, I was actually at the Financial Planning Association of San Diego. They had a financial summit this last week, and one of the discussions was about optimizing client happiness during retirement. And we heard from Professor Michael Finkel from the American College of Financial Services. And the 3 kind of core areas they talked about was money, relationships, and wellness. And so basically what they're sharing is for those that are approaching retirement and not retired yet, to practice retirement and to invest in imagination and really kind of think about what does retirement look like. And then those that are in retirement, they're saying establishing habits for retirement, because everybody has different goals and what they want to do in retirement. And so I thought that was kind of interesting. And we were just sharing before we hopped on this podcast that we said, Vince is going to Puerto Vallarta next week, right? He's practicing, not retirement, but he's practicing living life. So
I think he's practicing retirement.
There we go.
No, not at all. No. I'm not ready to retire.
A lot of people just work, they just work too hard to get to that retirement, and then they go, forgot to figure out what I'm going to do in that time period.
So one of the things you said, relationship. What's that mean? Like
so
with your wife or something?
That was brought up. They said those that have spousal relationships deepen in retirement, but they also said friendships. They said the source of friendships is really important in helping individuals really have a happy and healthy life. So it's like, interesting. You got to make sure you not only do you have your spouses, but those deep relationships with friendships.
I think that, and I'm just throwing this out because I think I remember this, that those people who are married actually live longer than those people who aren't. I'm pretty sure there's data that would agree with that.
And what was the last one? Money?
And then the last one was wellness.
Oh, wellness.
So basically investing in health and eating and exercising and, and once again, the longevity of people are living longer, which we're seeing.
I was investing in eating last night. I think I had half a bag
healthy.
of chips. That's but I'm not sure if that's a good investment.
And then one of the kind of stories that was shared was the ant and grasshopper. And basically, the fable goes that the hungry grasshopper begs for food from the ant during the winter, but it's refused, so the grasshopper ends up potentially dying. And so when you look at retirement, you kind of look at your spending, and are you, there's kind of 2 types of spenders. ants tend to save and spend less, and grasshoppers tend to spend, as much as they can. So it's interesting as you kind of hear that, if you are saving, a lot of times we find as people, those that save for retirement, they've accumulated a lot, and then they have all this money, and then sometimes they have a hard time spending that money because they're used to saving, that ant philosophy, and not really using the money.
Not enjoying it. The way they
No,
should.
and then or you have the grasshopper that's maybe not saving as much, or they haven't. They're spending, and so I thought it was kind of interesting because we do occasionally have clients that have accumulated a lot of money and they struggle with spending it, and they just have that mindset of like, how do I, what do I do? Or
Well, I have a quick question. They always talk about, when you retire, you should look at the 4% rule of taking 4% of your assets to live off every year. Is that still the case? They still use
that
it
was a rule of thumb. Really, when you look at, there's different ways you can look at retirement. You can look at, is there a total return? Are you trying to get income from your retirement assets? So it's rule of thumb is the 4%, but the reality is how is your money working for you and invested so that you can get the income you need.
What's
from
the current interest rate environment if you're trying to draw income off of it?
Yeah.
There's a lot of different ways to skin that cat.
Just curious.
Well, it also depends on how much you've saved in your life, how much of an ant you were versus being a grasshopper.
Yeah.
I think that's sometimes if people are far off from retirement, I've talked to them, what do you need? I said, well, 4%, think about drawing 4% when you're in retirement, and that's what you're going to be living off of, just to give them something to kind of shoot for. Well, they got to think about how much they want to spend then, and then you do the math, and they go, oh, gosh, I got to save a lot of money. And they might be the grasshopper spending it all and not saving enough.
Well, think about that. If, in order, let's say you need $160,000 on which to live, you'll need $4 million. To get that 4%. Now, you're going to be spending. You can spend your principal, but eventually, you're going to go broke.
Right.
So you need a lot of money in today's day and age to have $150,000, which is not so much out of line anymore. It's still a lot, I guess, in general. Yeah. But 100,000. I remember when I was going to college back in the dark ages when they still had abacus.
I thought it was barter back then.
Yeah. Well, this was back in the 1970s because I graduated in 74 from the University of Missouri, which has a chance of winning the NCAA basketball tournament this year, but probably won't. At any rate, back then, I remember talking to then my girlfriend, now my wife, and saying, if I could make $100,000, I would be filthy rich. Well, today, I think the average household of four probably makes, I don't know, I'm guessing $70,000, $80,000. And $100,000 for a family of four is, especially in California, is not easy to live on anymore.
Right.
So there you have it. I don't know if I'm an ant or a grasshopper. More like,
now what am I? Well, and then the other part of it was sharing that if you are the ant and you're not spending, then if you pass the money on to your family or whoever you decide to give that to, that they usually spend that money pretty quickly. So it's like there's a probability. So they're like, not to say you overspend, but obviously it's okay if you've saved well. You should enjoy life too.
I think that's one of the reasons, why wealth doesn't stay in a family unless it's super wealth. Yeah. Wealth doesn't really stay in a family very long because the kids end up spending it. Mm-hmm. And it's unfortunate, but that's in general that's what happens. Yeah. So anyway, all right. What else do we have to talk about this week? Nothing.
No,
it says it never rains in California. Well, we've had some rain in the last couple of days, so you never know what's going to happen. It's like the market; you never know when it's going to rain. And right now, it's raining.
Is it? There goes my golf game.
It was this morning, raining, but no thunder or lightning. So here we go. We should be okay. Anyway, that's it. I'll stop mumbling, and we'll see you guys next week.
Great. Thank you.
Thank you.
Bye.
Please stay tuned for important regulatory disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Wolf Weezy Magana, LLC, doing business as WWM Financial, Savvy Doc Financial Planners, and Savvy Woman Wealth Management, is a registered investment advisor with the SEC.